So in this class, we're going to see how many different things can have an impact on something else, such as the changes in the bank rate and the value of a currency. But these things, when they change, they may not lead to the impact that is described. So we have to understand why sometimes these changes happen and an impact ensues, and why sometimes it doesn't. Let's take a look. All right, so first and foremost, we have to understand that markets, exchange rates, alter based on changes in expectations. So every year you're going to see, or every quarter, you're going to see some businesses release their profitability, their results, how much money they've made in the last quarter. And afterwards, the stock price will adjust. And sometimes you'll have these very favorable results, but the stock price still falls afterwards. So why is that the case? Well, stock prices and the value of a currency is based on people's current expectations. So if you expect a company to release a statement saying that they've made $500 million in net income in the last quarter, and they've made $350 million in income in the last quarter, it's still a good situation making that much money, but it does not live up to the expectations. And that's why the value of that stock could fall. If, on the other hand, it says the expectations is that they make 500 and they release a statement saying that they made 500, it's in line with expectations, prices wouldn't change all that much. So similar thing happens with exchange rates and the interest rate that's being announced. So typically speaking, we say that as a country increases its interest rate, it's going to lead to an appreciation of that currency, to an increase in its value. But sometimes we see this increase in interest rate and we see no appreciation. So by seeing that, you could argue, well, it's not true what we learned in class that an increase in interest rates will lead to an appreciation of the currency. But I would say that when that happens, it's really based on the idea that the value of the currency pre-announcement was already expecting that increase of 0.5% in the interest rate. And therefore, because it was already expecting it, that increase in the value of the currency has already taken place. Similarly to the example of this expectation of 500 million in profit. If, on the other hand, the Bank of Canada would have increased the interest rate by 1% or 0.75%, then it's beyond expectations. And because it's beyond expectations, it's higher, then the exchange rate would go up rapidly because the market hasn't fully taken into account that information. They were expecting lower and they got more. So it's all about looking at longer time periods sometimes, because otherwise if you have this announcement and you look for a change and there's no change, well, it could make you think that it doesn't have an impact, but that's not true. If they would have announced zero change in interest rates and they would have expected a 0.5% increase, it would probably lead to a decrease in the value of the currency. Okay? So every time you think about stocks, exchange rates, or other things like that that are influenced by external factors, as we see in class, always ask yourself, if you see on the news that one of these things change, what's the impact on the other one? And you don't see the impact, ask yourself, is it because the market was already expecting that to happen or not? So hopefully that helps understand why some good results in quarterly statements by businesses or some increases in the bank rate may not lead to the expectation of an increase in the value of the stock or an increase in the value of the currency. And that's solely because the market has already taken into account that information within their expectations. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real-life examples. Have a good day.